I've created a simple example to step you through the concept of closing entries. This is the adjusted trial balance for ABC Co. for the year ended December 31st, X1. You can see we have permanent accounts up through retained earnings, and we have temporary accounts. Revenues and expenses are temporary accounts that appear on the income statement and are used to compute net income. The credit for revenues shows it has a positive balance in revenues, therefore it's added to net income. The debit in expenses shows it has a positive balance in the expense account because expenses are increased on the debit side. So we have $55 in expenses, which are deducted from revenues to arrive at net income. Then we prepare the statement of retained earnings. The beginning retained earnings will come from the adjusted trial balance, but retained earnings is the only account that really hasn't been adjusted yet because retained earnings are adjusted by dividends, revenues, expenses. Therefore, this $25 is actually the January 1st X1 balance because these accounts have not yet been closed into it. Through the closing process, we will make sure all these accounts get closed into this retained earnings. But just remember that the beginning retained earnings to be used on the statement of retained earnings comes from the adjusted trial balance. The way you know that these accounts have not been closed yet is because temporary accounts still have balances. The beginning retained earnings then goes on to the statement of retained earnings. Then the net income computed from the income statement goes on to the statement of retained earnings. And dividends are deducted from the statement of retained earnings. That gets us to the ending retained earnings balance. So after the closing process, this retained earnings amount needs to be a credit of $50. That credit of $50 appears on the balance sheet. So one of the goals will be to make sure that all the accounts have been updated to exactly agree with the balance sheet. And since none of these temporary accounts appear on the balance sheet, they all need to be zero. All temporary accounts, and you can use the acronym to remember them, REID, must be closed to match this ending balance sheet. R standing for revenues, E standing for expenses, I standing for income summary, and D standing for dividends. Visually, you can think of the closing process in this manner. In this blue box, we have all the permanent accounts, and in the red box below, we have the temporary accounts. The closing process will take these temporary accounts and put them into retained earnings and zero them out. All I've done is I've taken the adjusted trial balance from the prior page and I put their balance into their respective ledger account. What we're now going to do is go through the REID acronym to close all temporary accounts into retained earnings. R, revenues. Revenues currently has a credit balance of 90. How do we get revenues to go down to zero? The only way to do that would be to debit revenues $90. By recording this journal entry, a debit of $90, and posting it to the ledger account, revenues are now zero like they should be. But that journal entry doesn't balance yet. We can see from this diagram that revenues need to be closed into the income summary account. Therefore, we will credit income summary. The key point you need to see is that this credit of revenues was transferred into net income, but the way you had to do that is you had to debit revenues to zero it out and then credit the income summary account. Let's see if you can think what you'd do to close the expenses account. It currently has a debit of $55. How would we close this debit? The only way, since the debits increase expenses and the credits decrease expenses, we would have to credit it $55. Posting that to the ledger account, expenses are now zero. But to balance this journal entry out, we need to debit income summary. By posting that to the income summary account, you can now see that revenues have been credited to income and expenses have been debited to income. At this stage, we can move on to closing the income summary account into retained earnings. Currently, income summary has a credit balance of $35, which is what our net income was. We use an income summary account so that when we finish closing revenues and expenses, we can verify that the balance matches our net income. If the balance in income summary before closing it is a credit, that means you had net income because your revenues were greater than your expenses. However, if these were reversed, if you had $90 of expenses and $55 of revenues, you would have a net loss of $35, which net loss would be debited to retained earnings. Now, how would we close this income summary account? Since it's currently a credit, we would have to debit income summary. We post that debit into income summary account. Income summary is now zero. But this journal entry needs to balance, so we need a credit of 35, and that 35 will appear as a credit in retained earnings. And that makes sense. Net income increases retained earnings. Finally, we need to close our dividends account. It currently has a debit balance of 10. To close that, we would need to credit it $10. By posting that, our dividends are now 0. To balance out the entry, we need to debit retained earnings, which will reduce retained earnings by 10, and our ending retained earnings are now 50, which is exactly the ending retained earnings which we computed on the statement of retained earnings. We've just finished the closing process for that simple ABC Company trial balance. Looking at it from the big picture again, we took all the temporary accounts and we closed them into retained earnings, causing retained earnings to go from a credit of 25 to a credit of 50. After all the temporary accounts have been closed into retained earnings, only permanent accounts will carry amounts forward to next year and will appear on the post-closing trial balance. All temporary accounts are now 0 and are ready to capture new data for the new year.